Hello and welcome to our podcast, Mississauga Life and Real Estate. I'm your host, Sean Jaffrey, joined by my co-host, Alex Stakic. And Alex, we have an interesting podcast today. A whole bunch of topics that we haven't discussed before. How you feeling about that?
Hi, Sean. I hope you're doing well. And of course, I'm very excited to see what topics we're covering today. I know some of them will be very, very hot topics. And let's tackle them.
Okay, awesome. Okay, let's talk about inflation. The hottest news right now is the Bank of Canada came out with a little speech talking about his forecast about what's going on with inflation, what they expect for the economy to do. So I had like four main takeaways from this speech, and I'm sure you've gone through it as well. The first one was that inflation is not just an international supply chain issue. So I'm just going to quote him here. He says that the demand, and by him I mean the Bank of Canada chief, Tiff McKellen. So Tiff says the demand for goods and services here at home in Canada is running ahead of the economy's ability to supply them. So I take from that the demand is so high that all the supply chain issues aside, even if they weren't there, the suppliers would have a hard time getting those to us because we just want them so badly.
Yes, absolutely, I agree with you. And this is a very good quote. If you remember, we had the highest peak of inflation in July. It was 8.1, and everybody was talking about the war in Ukraine and about oil, gas prices, and that these two major things are affecting our economy in regards to inflation. But now we came to the point that in August and September, actually, these inflation numbers dropped. I think it's about 7%. And now for the first time, we are hearing that supply chain actually supplies less than our demand. So not only international factors are affecting our inflation, but internal factors as well.
Yes, 100%. So there's another angle to all of this.
Absolutely.
The second takeaway I had was that they are closely watching core inflation. So inflation, when we talk about the inflation numbers, like you just mentioned, right? You said we went from 8 to 7%. That takes into account everything, including volatile items like the prices of food, right? Core inflation is something that detaches itself from volatile items like price of food. So the chief was saying that they are keeping a close eye on core inflation, and obviously depending on that inflation, they're going to adjust rates going forward. The third takeaway I had was that they're watching inflation expectation. So another way they adjust the interest rates, the Bank of Canada does that, is based upon you and I, what you and I are thinking about as consumers, where our projections lie. You know, where do we think we're going to be in terms of inflation down the road? And the Bank of Canada takes that, they do a survey, and then they also use that when they implement their policies on interest rate hikes.
Yes, absolutely. This is actually, this is a consumer expectation. I think they're taking under consideration expectation of the inflation in the next 2 years. And based on graphs I was watching yesterday, I believe that broad expectation of the Canadians that our inflation will be next year around 5%, what is pretty high. If we know that we're looking for some inflation between 2 to 3% as a stable market and stable economy. So this is very much higher expected inflation than we are looking for. So that also affects overall, concerns of the Bank of Canada, how this inflation should be adjusted and how interest rates should be applied from the actually month to month.
Correct. I'm just going to read a few quotes, Alex. I think it's worth noting. Here's a quote. We are closely watching inflation expectation, keeping longer term expectation of inflation well anchored is paramount, so that as inflation pressures ease, inflation returns to the 2% target. So we know that the Bank of Canada is mandated to keep the inflation between 1 and 3%. Also went on to say that the longer higher inflation persists and the more pervasive it becomes, the greater the risk that high inflation becomes entrenched. Now, I don't know what you take of that, but from what I'm understanding is that if the inflation isn't brought under control sooner rather than later, hence the interest rate hikes, then the longer high interest rates or the longer the inflation lasts, the higher the chances are that it'll be there for a very, very, very long time. hence the aggressive interest rate hikes right now preemptively by the Bank of Canada.
Yes, because it's always a question of economy flexibility and adjustment to real situation from month-to-month basis. But economy depends on many different factors, not only international factors but our internal factors, and what will be the number of new immigrants coming to country, right? One of the very important factors. And we've seen our graphs, we are talking later on what we can say about that as a promising factor. But so far, inflation is very, very persistent animal, and it's not easy to get rid of that. You know that.
Interesting take. And the fourth takeaway, I think the heaviest one here is the clear implication that further interest rate increases are warranted. So clearly, October 26th, we're going to see an interest rate hike anywhere from 0.5 or more, but that's still yet to be seen. So on a positive note, Alex, population growth last quarter was at 700,000, and that's the strongest quarterly increase we have on record.
It's unbelievable, really unbelievable. And I noticed that population growth in quarter 3, 2022 was 3 times more than 2015 same time. I don't know when we had that population growth, right? So
and
this is a very important fact.
100%. And we know that when people are usually, given permanent residence or immigration numbers are increased and we let people into the country, we're letting people of value into the country. I know that we have our quotas for when it comes to, people with refugee status. But other than that, typically when we're getting somebody into the country, they're either very qualified professionals or they're coming here with some money. They're going to start a business. There is some sort of quota for that. So that's good. This is a reminder for us that, rates and affordability are obviously important when you're looking at the real estate market or the economy in general. But this tells us that the long-term fundamentals are still pretty solid. When you have immigration coming in, when you have people coming in with money, with qualifications, it only adds to the economy and doesn't really take away from it.
Yes, and if you see graphs, for example, for 2021, our population growth in Canada year over year in 21 was barely 100,000 people. And that, of course, when you compare 2022 with 700 year over the year, or 300 in the last quarter of this year, seems to be very promising. So this is very important driving force of our economy, and one of the factors that will stabilize on the long run our inflation as well.
Yeah. Let's not forget that, out of all the developed countries in the world, Canada is still, I would say, in the top 5 places out of 180 something countries that people want to move to. So, like I said, the fundamentals are still strong. So that's that's a positive thing coming out of what's happening in the last couple of years. Now let's move it a little bit to something local. Let's talk about the market being still well balanced, right? So I wanted to bring this up with you. Months of inventory. How important is it to take a look at the real estate market from the perspective of months of inventory?
You and me, we are watching this is our job to take all these factors under consideration and to follow the key numbers. And usually I'm preparing reports for my clients on monthly basis for MarketWatch, for actually Toronto Real Estate Board. And we've seen, for example, year over the year, September last year comparing this year, we had dropping of listings for almost 44% from I don't know 9,000 listings to 5,000 listings, and average selling price was dropped for 4.3% between this September 2022 and September 2021, right? Again, not only that, we have another different factors. Not only how many properties we have or what is average price, how much it takes to be sold, and numbers are that from 23 days in September last year, we came to 29 days. So it's not easy to sell as before. And I believe that sellers are expecting to get prices as they had in March or April. And I'm discussing with some of the clients who are saying I would like to sell in March next year. I believe we will have some reset of the prices, and it will be better for me to sell at that time. What is your opinion about that, Sean?
So what I think is when it comes to the month of inventory, first of all, let's just define what months of inventory are. Months of inventory is simply if there were no new listings to come on the market today, it would take us about 3 months to get rid of all of the homes that are available for sale, right?
Yes.
So that's months of inventory. When we talk about when we had a crazy year last year where prices were jumping 10, 15, 20%, the
Yes.
months of inventory last year were around 1 month
Yes.
of inventory, right?
Yes.
A serious shortage of inventory. So now we're at 3. But surprisingly, this is by no means a crash or a buyer's market because we've been at around 3% or 3 months rather for a long time. I take a look at the graphs from the last, let's say 2007, we've actually been at 3 months of inventory or more, 2007, 8, 10, a whole bunch of times. So this is nothing new. This is nothing scary. I think right now, being 3 months of inventory, we're still doing okay, right? That's my take on it.
Absolutely agree with you. We forgot what is the normal market.
Right, exactly. So a very important last thing that I wanted to discuss with you, Alex, was concerns about assignment sales. You do a lot of pre-construction. You're a big player in that field, and people a lot of times. Let's keep in mind this is not a majority of investors, but a small percentage of investors always invest in pre-construction with the intention of never closing. Right? They want to kind of wait a few years when the builder allows, then they take that assignment clause, and then they sell the contract to the next buyer, and then make some money off of that. Now, what we're noticing is that the assignment concern is really around the fact that a lot of people, that we're talking about, the small, amount of people who buy with the intention of selling with the assignment, if they are not going to be able to close because the rates have gone up, and they initially never had the means to close to begin with, they were just planning on selling the assignment. What sort of effect do you think that can have on the market? Because now we know that resale sales are down 50%. You mentioned 44%. We know that pre-construction sales are the lowest they've been in 20 years, right?
Yes.
How
Yes.
much of an effect do you think that could have, on the real estate market in general?
We discussed last time about these real estate investors, actually speculators who are buying intentionally with the idea to sell by assignment, hoping that market trends will be always in very high and positive numbers, never thinking about the way and possibility that will come in situation like right now. I don't want to say that pre-construction market is frozen. It's not. But probably 50% or 55% comparing times when we know how market was crazy 6 months ago. So yeah, I'm getting calls from them and asking what to do. And I never advise the client to work in the way intentionally to buy a property and with the no any intention to close, but really buy what you really want to close and hold for the many years. Don't be in this hassle right now, because what is their option? If they are not able to close, and most of them will not be able to close, they will lose their deposits, and deposits are pretty heavy. You know that for every investment you have to put 20% down prior to the closing, so minimum 15% most of them already gave on $600,000-$700,000 property they bought, and minimum, and plus in pre-construction, they will lose around $100,000 without chances to get this money, and most probably because prices, if builder sells these properties below the purchasing price 2 years, 3 backs ago, builder has full right to sue them for all damages, plus court lawsuits and all other costs. So, either they will find a way to sell with the less loss, or they will lose deposit.
Yeah, so it comes down to the same thing that we talk about. The fundamentals of real estate investing is when you're investing in real estate, don't invest with the idea of flipping it within a year and making $200,000. It's happened before. It does happen from time to time, but it's not the norm. It's not the rule of thumb. So if you're going to invest in real estate, if you don't have the capacity to hold on to it, should the market shift, then maybe you should wait and see what happens and not put your money in. And never lock in your money into real estate investment, especially pre-construction, with the idea of I'm going to be able to sell the assignment and make the money, because there's never any guarantee. So if you're not going to be able to close, A, you lose your deposit, and B, the builder's going to sue the pants off of you because they have the means to do it. You signed a contract. And if you were, if you did your due diligence and your lawyer read the documentation, he'll tell you if you don't close, you're in for a world of trouble, right? So
yes,
fundamentals of real estate: invest for the long term, not for the short term.
Yes, and I would like to stress another very important factor in regards to investors, because not all investors are in pre-construction. You have investors who are buying move-in-ready properties, and if you take a look on the graphs, right now negative cash flow for the investors who are buying average property is around $800 a month, comparing around $400 a month a year ago. So message is: be careful where and when and how much you will invest. If you're willing to have negative cash flow, make your projection how long you can hold this negative cash flow and what is your long-term take on that. Because definitely you will be able to increase rents because more people are coming, salaries will be increased, everything will be increasing. Sure, probably you will not be break even in 2 or 3 years, but are you willing to hold that negative cash flow for all these years? Benefits will be probably some increase of the prices in a couple of next years, but this is something we can discuss on individual level with every potential investor.
Yeah. So on average, if you were in a negative cash flow last year of $400, now it's $800 a month. So if you were in a negative cash flow of $5,000 last year, now you're doing $10,000 this year of negative cash flow. So if you can handle it and you can hold out for the next few years, good for you. You'll save like 20 to 30% of the purchase price had you bought like 6-7 months ago.
Yes.
If you can't, something for you to discuss and kind of look at your bank balance and see if you can hold on to that or not.
Absolutely.
Right?
Absolutely.
Awesome. So we discussed a few very key things, Alex. Thanks again for joining me, and we'll see you in the next podcast.
Thank you, Sean, for inviting me. Have a great day, and thank you for your time. See you soon.
All right. Take care.
See you. Bye-bye.